We're going to be doing a deep dive into VYM, Vanguard High Yield ETF. Since the start of this whole situation with, let's take up the mental and call it with what Jeremy says, Rona. What's going on? Why even look at it? Are an ETF's bad? Are an ETF's good? So I'm looking at it. I'm looking at the performance for this thing for the last, well, since inception. It's not really that good of a performer. It's kind of like on the poorer side of performance. Let's take a look at what you get with this ETF. It's an exchange traded fund. At this point in time, right now, when I'm looking at it, it has 423 different companies that you're going to be getting when you buy into it. Some are good, some are bad, some are meh. Some you've never heard of, and yet apparently you're going to be putting some of your money into it. VYM is very popular because it has the high dividend yield, and a lot of people like to do the drip when it automatically reinvests every time, and you roll it over and it compounds and it grows. The world is changing, folks. This is not a good place to have your money. So let me just go over a little bit of what it has. Some good companies that it has in the index. A lot of these are up in the bigger percentages of where your money will be, and then some of the bad ones are a little bit lower, and then some of the meh ones are like throughout, and then some companies you've never heard of are probably on the lower end. They don't have a whole lot of money in those companies. For example, the top 3 companies have, let's see, 1,000, million, billion, trillion, over $1 trillion invested in each. And then by the time you get to the very last few companies, it's in the millions. It's not a lot of money. So let's say you put, I don't want to say $10,000 portfolio worth, but let's say you put $100,000, you still wouldn't be getting a whole lot of the companies on the lower end of this chart. You'd be getting a very small portion of it. The good companies, in my opinion, of course, are Johnson & Johnson, Procter & Gamble. I consider Chase a good company. Verizon's a good dividend company. AT&T's a good dividend company. Walmart, McDonald's, Next Era Energy, and then also Waste Management. Some of the companies that aren't so awesome that get lumped in and keep the price of this ETF down. Well, Intel's not doing all that hot right now. Comcast isn't all that amazing. Bank of America isn't all that amazing. You get Philip Morris, Altria. You get a bunch of gas stations, a bunch of gasoline producers, a bunch of gas companies. When I say gas, I mean petroleum. You know, it's general, the entire sector. I don't know if I went over IBM. Some of the other companies that are meh are like TD Ameritrade. Western Union hasn't done very much in there. We have like PepsiCo. That's not very up or down. It pretty much hovers like flat. You've got companies like Coca-Cola, Cisco. I don't know. Some of the companies I've never heard of, like Illinois Toolworks. They're in there. Do you know what they do? You're putting your money into it. There's a company in there called Eaton. Do you know what they do? Your money's going into that company when you buy VYM. There's a company in the collection called KLA Corp. Look it up. I don't know what it does. Why do you want me to tell you? They also have money in American International Group, AIG. This is what I had compiled, but let me go through all, I don't know, like 20, 30 pages, see if I can read off a few that stick out to me real quick. There's quite a few dollars into Exxon. They've got AbbVie, Amgen, Bristol Myers, Broadcom, that's good, Qualcomm, that's good. Lind PLC, I don't know what that is. Texas Instruments, I don't know. Is that where you want your money to be, in Texas Instruments? Texas Instruments. I don't know. You have UPS. You have Citigroup. You've got a lot of banks in here. I'm waiting for this page to load. You got Lockheed Martin, 3M. Those are all right, I guess. You got Wells Fargo. I don't know why. You got Raytheon. You have Gilead. You have CVS. Like, it's such a wide cluster of companies. Like, how are you gonna figure out what's good or what's bad? And for all of this complexity, all of these different companies that you're investing in, the dividend isn't even that amazing. I know it's tracking another index, and it's just matching that other index, and the fee is very, very low. But I mean, some of these companies, Dominion Energy, Air Products and Chemicals, CME Group. Okay, ADP, we all know. Duke Energy, that's kind of like, it's made a couple splashes. You might know about it. Morgan Stanley, of course, you know. Maybe you've heard of Chubb. Have you heard of Chubb? I don't know. Your money's going into it. It's not on the last page. I'm on the second page. There's Progressive, Southern Company, Kimberly-Clark. They make the toilet paper. Truist Financial, Bancorp, PNC Financial Services, Emerson Electric, DuPont, ConocoPhillips. You got American Electrical Power, General Mills, Excel Energy, Sempra Energy. You have Cummins, Johnson Controls International. You have MetLife. Do you want to put your money in MetLife? You get Walgreens Boot Alliance, you get Prudential, you get Kinder Morgan. It's not even based in the U.S. Nobody said Vanguard High Yield had to be U.S. companies. You get Public Service Enterprise, Aflac, Phillips 66, Best Buy. Yeah, Best Buy's in here. Random. That's the way it is. Welcome to VYM. It's such a cluster. Discover Financial Services. You got Kellogg's, Tyson, Maxim Integrated Products, ConAgra, PPL Corporation. Yeah, that's the name, PPL. It's not like doesn't have another name. It's just PPL. You got Valero, you got Hershey, you got Hertz and Kraft. State Street, you got Paychecks. Some of these I've heard of. A lot of these I've heard of, but a bunch of these, like, what's going on? You know, Fifth Third Bank, Cardinal Health, Synchrony Financial. I mean, I know Synchrony Financial. I know Fifth Third Bank, International Paper, Halliburton, J.M. Smucker, Genuine Parts, M&T Bank, Hewlett Packard Enterprise, Seagate Technology. Based on the performance of VYM and based on the dividends that you get out of it, in a $10,000 portfolio, if you were to start investing, I recommend your first $1,000 be into an ETF. You can put it into Vanguard ETFs. There's no minimum requirements. You just open it up on Robinhood and you can buy it. I would not recommend you buy VYM. There's a lot of options through Vanguard. Let me go over a few of those as well. So right now I'm looking at VYM. We have VV, which is Vanguard Large Cap. We have MGC, which is a Vanguard Mega Cap. We have ESGV, which is kind of new. I like that one better. It's more of like an environmentally friendly type of ETF. It more screens and filters out the companies that aren't necessarily headed towards a better future. So I believe this one will have a good growth, but I don't know. I can't guarantee anything. I don't know. So that's something you can look out for. There's a VUG, Vanguard Growth ETF. This one I don't have high regards either. We have a VIG Dividend, Vanguard Dividend Appreciation ETF. Don't get into that. I'm looking at the performance for a bunch of these. Between VIG, MGK, MGV, MGC, and VTV, that's a lot. That's a lot of names. The best performer by far is MGK, and MGK was, I believe, the large cap or the mega cap. Those ETFs have fewer stocks in them. Their costs are lower, and they're performing better. So if you're gonna start putting money into the stock market, your first 1,000 should go into ETFs. Face it, you don't know what you're doing. $100 a month, 10 months worth of putting money in. Even if you didn't put money in anywhere, you just put it in an envelope in a drawer somewhere, you would have $1,000. Put it into Vanguard. Put it into, I forgot what I said, MGK. You're probably going to get better performance, better outcomes. Yeah, MGK is the one that's going to be doing the best for you. You could also put it into VOO, but that's not really pushing anything special. Let's see what VOO looks like. Yeah, VOO is the second better performer of all of them. I've got a MGV, I guess that's Mega Growth. I think that's the Mega Value. That's a global value. It's not performing all that great. It's not worth it. So keep it simple. MGK, VOO, your first $1,000, that's where it should go. Please like, subscribe. I'm going to leave a link down below. It's for signing up for Robinhood. You get one free stock. Recommendation: as soon as you're able to sell that free stock, sell it. Don't keep it. Whatever whatever Robinhood gives you for free is junk. It really is. It's not worth anything. They're going to give you some company that might go up, might go down, but its long-term potential is not there. It's a stock that I guess has a lot of flow, a lot of interest, but somehow Robinhood ends up stuck with those, like holding the bag because something went wrong somewhere down the line. So it's like, okay, well, we can give this away for free, and we can write it off in a different way. So you don't want to be keeping the stuff that Robinhood gives you for free. You can open a Vanguard account. You don't have to have the $3,000, $5,000, whatever, $1,000 minimum deposit required to open an account. You're just going to be buying into their ETFs, and you're going to be buying them as like regular ETFs. You're not going to be in the fund. You're not going to be getting special rates or whatever. It's fine. I don't recommend Vanguard for one specific and clear reason. When you try to sign up for an account with them online, they end up asking you to print something out, mail it back to them. Like, come on. Online. Why? All of these other companies are online, electronic, everything. You're asking me to print something, put it in a mailbox, and send it to you? Come on, Vanguard. Your ETFs are great. Let me get back into this real quick. I know it's going on a little bit. When you're going through Vanguard, they have international ETFs, they have bonds, they have mid cap, they have small cap. Don't do it. Don't do it. The best returns are large cap. You don't want to mess with medium cap. You don't want to mess with small cap. Don't go diversify with your first $1,000. Just put in a large cap and see it ride. What you want to do is gain experience with volatility. You want to gain experience with seeing your money on the wave going up and down and up and down and up and down. You don't want to be, oh, I'm going to time this. No, you don't know anything about the market. You don't know. Why are you trying to be I don't know how to say it for YouTube. A smart donkey, so that you can try to say, oh, I did better in my first year ever. No, just put your money in, figure out what these companies are, learn. You have a whole year to learn, first 10 months to learn. Once you have $1,000, if you did get dividends from that, great. Now keep adding another $1,000 into it. When you're at your second 1,000, you could sell half of that initial 2,000, the 1,000, and you can buy one stock that you really, really like, and keep the other half of the money into that ETF. So your first $2,000, you're not really making any moves. Half the money is going to be in a ETF, and the other half of the money is going to be in one stock that you really, really like. I don't recommend doing speculative stocks, but you know what? You're starting off new. You might get lucky. I don't know, but I would just see if you could filter it down and find that one company that you really love. Make sure it's a name that you know. It's a name you're familiar with. It's a name that you hear a lot of buzz around, a lot of people talking about it, a lot of people saying good things about. Not just you. A lot of people need to be saying good things about it. Tesla. Well, let's put that into YouTube. Millions of videos will come up. Microsoft. Lots of people talking about them. Nvidia. Everybody's talking about them. Intel. People are talking about them, but is it all good stuff? No. It's not necessarily the best to put your money in a company that everyone's saying good things about. But that's a part of the learning process. You need to be in a position where you don't necessarily get the best results, but you learn a lot about how the market works. When you give yourself a year, you see dips, you see growth spurts, you see daily volumes, you see short positions, you see long positions, you see options activities. When you were actually in the market, you learn a lot from all of these little things that I'm telling you about, where you're going to be like, what are some of these things that you talk about? What does volume have to do anything with anything? I don't know. You're not going to find out until you put your money in there. Well, I do know. I'm not telling you. I'm not trying to hold back, but some things you just don't learn off of a YouTube video. You got to put yourself in there and get going. Just get going. If you can't figure out how to obtain another $1,000 or $100 a month for 10 months straight, the stock market's not for you. If you're going to put $1,000 in that you borrowed off of a credit card, stock market's not for you. The $1,000 you need to put into the stock market is $1,000 that you have in a shoebox, in an envelope under your mattress. It's money that you're not doing anything with anyway, and it shouldn't be all of it. Yeah, if you have like $5,000 in an envelope under your mattress, take $1,000, put it in the stock market, see what happens. Don't put your money in a bank account, savings account. That's nonsense. That's garbage. Even the worst funds, even like the worst bonds on the stock market, give you better returns than a lot of these banks. I hope we figured some little things out about Vanguard. I hope we figured out a little bit of things about investing. I'll probably make a dedicated video about more towards how to invest your first couple $1,000s, and then I'll probably go into more Vanguard topics for future videos. I'll see you then. I hope you're there with me. Please like, comment, subscribe. If you haven't opened an account at all with anybody, the only company I'm recommending is Robinhood. The only thing I don't like about Robinhood, everything is excellent. The only thing I don't like is its information. Get your own information from everywhere else. Get it from Nasdaq.com, get it from investing.com, get it from Yahoo Finance, get it from anywhere, and just compare it with Robinhood. Robinhood doesn't necessarily have enough oomph, enough horsepower to bring too much complexity into the app. If it's a heavy trading day, if there's a lot of volume, Robinhood would restrict these features anyway. So you would end up having to use another service anyway. Robinhood is good for buying and selling. It's not good for tracking. It's not good for learning. It's not good for developing. So yeah, open a Robinhood account and then see what happens with everything else and how all of that works out. I'll see you guys in the next one. Thank you. Bye.